On March 27, 2002, on a routine earnings call, Adelphia Communications disclosed a single footnote that had never appeared in its consolidated financial statements. The company acknowledged $2.3 billion in bank debt, for which it was jointly liable but had not carried on its balance sheet. Analysts asked the chief financial officer to explain the exposure. The answers were vague. The stock lost roughly half its value over the following days. Within weeks, 3 borrowing entities named Highland, Doris, and Coudersport surfaced in the disclosures, and no one on that call could account for what they were. The structural question is narrow. How does a publicly traded company become liable for billions in debt that its own balance sheet does not show using an instrument the banks and auditors had approved? The instrument at the center of Adelphia was the co-borrowing agreement. Understand it correctly. The entire fraud rests on it. A co-borrowing facility is a legitimate lending structure. Multiple related entities enter a single credit agreement with a syndicate of banks. Each borrower can draw on the total facility. Each is jointly and severally liable for the entire balance. That last phrase is the load-bearing element. Joint and several liability means that if one borrower draws the money and cannot repay, the lenders can pursue any other borrower on the agreement for the full amount. The banks like this because it broadens their recourse. The borrowers accept it because it lowers their cost of capital. A pool of entities can borrow more cheaply together than anyone could alone. For a cable operator, this is ordinary. Building cable systems is capital intensive. Adelphia operated through many subsidiaries and affiliated partnerships, and pooling their borrowing capacity was a defensible way to finance network expansion. The accounting question is where the structure begins to bend. Under generally accepted accounting principles, a public company must consolidate onto its balance sheet the debt of entities it controls. If a borrowing entity is genuinely independent, separately owned, separately managed, drawing for its own purposes, its debt might sit off the public company's books. But joint and several liability does not disappear because an entity is off balance sheet. The obligation remains. So does the disclosure obligation. The legitimate baseline is precise. Co-borrowing pools capacity and spreads liability. Any debt for which the public company is jointly liable must be either consolidated or, at minimum, disclosed as a contingent obligation. The fraud at Adelphia was not the existence of the co-borrowing agreements. It was the deployment of them to move debt off the public balance sheet while keeping the liability, and to conceal that liability from investors. Here is how the architecture was assembled, according to the SEC's enforcement record and the complaint the Commission filed in 2002. Step 1. The founding family controlled both sides of the agreement. Adelphia was controlled by its founder and members of his family, who also owned a network of private entities, cable partnerships, and holding companies held outside the public company. The SEC's complaint identified these as the Rigas family entities. The same individuals controlled the public company and the private entities, so the co-borrowing agreements were signed between parties that were not at arm's length. The 3 entities named on that March call, Highland, Doris, Coudersport, were among these controlled borrowers. Step 2. The co-borrowing facilities were structured so that both Adelphia's public subsidiaries and the private family entities were joint and several borrowers on the same credit lines. The SEC found that the total co-borrowing capacity across these facilities reached approximately $5.6 billion. Adelphia's public subsidiaries were fully liable for the entire balance drawn under these agreements, regardless of which entity actually took the cash. Step 3. The private family entities drew on the facilities. According to the Commission's complaint, the Rigas family entities borrowed heavily against the shared lines and used the proceeds for their own purposes. That included the purchase of Adelphia stock in offerings, the construction of a golf course, and the acquisition of timber rights and luxury properties. The family used the co-borrowing facilities as a source of personal and private entity capital. Step 4. The accounting maneuver. When the private entities drew on the facilities, that debt was recorded on the private entity's books, off Adelphia's public balance sheet. But Adelphia's public subsidiaries remain jointly and severally liable for it. The public company's balance sheet therefore understated its true debt by the amount the private entities had drawn and could not independently repay. The SEC's complaint set the concealed co-borrowing liability at approximately $2.3 billion, the figure disclosed on the March call. Step 5. The reclassification of debt to hide the drawdowns. To keep reported debt within limits that would not alarm lenders and analysts, management moved liabilities between the public company and the private entities through journal entries. It reclassified related party payables and receivables to net down the apparent exposure. The SEC found that certain co-borrowing debt was shifted onto the books of the private entities specifically to reduce the debt reported by the public company. Step 6. Fabricated operational metrics to support the fiction. The complaint alleged, and the record established, that Adelphia inflated its reported cable subscriber numbers and its earnings before interest, taxes, depreciation and amortization. Cable operators were valued heavily on subscriber counts and EBITDA. By overstating both, Adelphia made its debt load appear serviceable relative to its cash-generating capacity. The two frauds reinforced each other. The concealed debt was easier to hide when the operational picture looked strong enough to carry it. Draw the structure in your mind. The public company on one side, the family entities on the other. A single set of credit agreements binding them together in joint liability. Cash flowing to the private side, debt disclosed on the private side, liability resting silently on the public side. That is the machine. The detection question follows directly. This structure ran for years. The co-borrowing agreements were real documents, signed with real banks. The debt was recorded somewhere. The verification chain did not catch it. Consider each gatekeeper in turn. The lenders knew the structure completely. The banks that syndicated the co-borrowing facilities drafted the joint and several liability terms. They understood that Adelphia's public subsidiaries were liable for the full balance. But the bank's interest was recourse, not disclosure. Joint and several liability protected the lenders precisely because it did not depend on which entity drew the money. From the bank's position, the structure functioned as designed. Disclosure to Adelphia's public shareholders was not the lender's responsibility, and the record shows the facilities operated as valid credit agreements throughout. The auditors sat closer to the accounting treatment. Adelphia's external auditor certified financial statements that did not fully consolidate or disclose the co-borrowing liability. To catch this, The auditors would have had to trace the co-borrowing draws to the private entities, confirm that the public subsidiaries remain jointly liable, and require that liability be reflected on the public balance sheet. The related party reclassifications made this tracing difficult. The entries netted exposures across a web of controlled entities that shared management and ownership. Early detection required one condition: independent verification of the related party transactions. Verification that the net down entries between the public and private entities reflected genuine arm's-length obligations rather than concealment. The analysts covering Adelphia relied on reported subscriber counts and EBITDA. Those metrics were inflated. An analyst modelling Adelphia's leverage from its public filings could not see the $2.3 billion in co-borrowing liability. It was not in the filings. The verification chain failed at the point where the public financial statements were the only window analyst had, and that window had been engineered to omit the exposure. The common thread is control. The same family controlled both the public company and the private co-borrowers. So every transaction between them was a related party transaction, and related party transactions are the specific point where independent verification is hardest. When the counterparty is controlled by the same person, the ordinary check collapses. Does an outside party agree this obligation is real and correctly recorded? There was no outside party. The unraveling began with disclosure the company could no longer avoid. By early 2002, the accounting environment had shifted. Enron had collapsed the previous autumn, and off-balance-sheet structures were under intense scrutiny. In that climate, Adelphia's auditors required the company to address the co-borrowing exposure in its financial reporting. The sequence, per the public record, ran as follows. On the March 27, 2002 earnings call, Adelphia disclosed the co-borrowing liability of approximately $2.3 billion. The vagueness of management's answers regarding the exposure and the named entities drove the immediate collapse in the share price. The SEC opened a formal investigation. Adelphia was unable to file its annual report on time. In June 2002, Adelphia Communications filed for Chapter 11 bankruptcy protection. The SEC filed its enforcement complaint in 2002, charging the company and members of the controlling family with fraud. The Commission's complaint characterized the conduct as one of the most extensive financial frauds ever at a public company. The record established that the co-borrowing liability had been concealed, that operational metrics had been inflated, and that the family had used the shared facilities for personal purposes. Criminal charges followed. A federal jury in 2004 convicted the founder and one of his sons of securities, fraud, and related counts. A second son was acquitted on some counts, with a mistrial declared on others, and the record was later resolved. In 2005, Adelphia settled with the SEC. The company's assets were ultimately sold, principally to Time Warner and Comcast, through the bankruptcy process. The mechanism collapsed at the exact point of its concealment. Once the co-borrowing liability was disclosed, the joint and several nature of the debt meant investors could no longer separate the public company's leverage from the private entity's draws. The $2.3 billion moved from footnote to balance sheet in the market's eyes overnight. The equity value fell to match. What the Adelphia case establishes structurally is narrow and durable. Joint and several liability does not respect the boundary between a public company and its controlling insiders. When the same parties sit on both sides of a co-borrowing agreement, the off-balance sheet placement of the debt is an accounting choice, not an economic reality. The liability exists regardless of where it is recorded. In the enforcement and regulatory response, related party transactions and off-balance-sheet obligations received sustained attention. The Sarbanes-Oxley Act, enacted in July 2002, required certification of financial statements by senior officers and strengthened disclosure requirements for off-balance-sheet arrangements. The Adelphia record demonstrates one point. The verification chain is weakest precisely where the counterparty is controlled by the same hand that signs the statements. The finding is not about character. It is about the structural blind spot that common control creates in every gatekeeper's ability to verify.